Government has at this point announced measures to regulate pricing of drugs and consumables in private hospital. We have the Delhi Minister, Health Minister actually addressing the press conference. Let's cut
अगर
back.
किसी की डेथ हो जाती है, डेथ होने के बाद उसकी बॉडी को पूरी डिग्निटी से उसको रखना होगा और साथ ही साथ ऐसी शिकायत कभी कभी आती है कि भाई बॉडी देने से मना कर रहे हैं, वो बिल्कुल नहीं किया जा सकता। कभी भी ये नहीं कह सकते कि जी आपने किसी की डेथ हो गई है कि जी आपको बॉडी तब देंगे, पहले पेमेंट दीजिएगा, वो पॉसिबल नहीं होगा। इसी तरह से कुछ शिकायतें आई थी कि भाई कुछ आर्बिट्री चीज़ें लगा देते हैं, जैसे कि बिल के अंदर डोनेशन डाल देते हैं कि 50 रुपये पर डे डोनेशन देना है। बिलिंग चार्जेस कि ये 200 रुपये रोज़ के बिलिंग चार्जेस लगा दिए, तो इस तरह के कोई भी चार्जेस लगाने अलाउड नहीं होंगे। इसके साथ साथ जो भी अपने चार्जेज हैं उनको ठीक से डिस्प्ले करने होंगे सब जगह। अभी जो ये है एडवाइजरी जो हमने ड्राफ्ट बनाई है, इसको लॉ के रूप में लागू होने में 30 डेज़ लगेंगे। इसको हम पब्लिक ऑब्जेक्शंस एंड सजेशंस के लिए डाल रहे हैं पब्लिक डोमेन के अंदर। 30 डेज़ के बाद इसको मैंडेटरी लागू करेंगे। साथ ही साथ जो दिल्ली नर्सिंग होम एक्ट है उसके रूल्स में भी बदलाव कर रहे हैं ताकि ये डायरेक्शंस जो नहीं मानेगा उसका लाइसेंस कैंसिल किया जा सके।
इस पर कोई क्वेश्चंस?
सर ये जो पेमेंट ना देने की अमूमन होता रहता है कि पेमेंट नहीं दी जाती तो डेड बॉडी दे देते हैं, इस पर क्या प्रावधान रखा है?
इसके अंदर प्रावधान ये है कि डेड बॉडी को कोई भी रोक नहीं सकता है। जैसे कि आप समझने के लिए बताता हूँ मैं आपको किसी के पैसे रख देने हैं तो वो आपको बंधक नहीं बना सकता। जब जिंदे आदमी को बंधक नहीं बना सकते तो उसके शरीर को भी बाद में भी नहीं बना सकते, बंधक नहीं बनाया जा सकता है। ये बिल्कुल इसके बाद सख्ती की जाएगी, उसका लाइसेंस कैंसिल कर देंगे। मैं कह रहा हूँ कि हम नर्सिंग होम एक्ट के अंदर बदलाव कर रहे हैं, रूल्स के अंदर बदलाव कर रहे हैं। अगर जो इसको फॉलो नहीं करेगा उसका लाइसेंस कैंसिल कर देंगे।
एक एक करके
पैकेज वाला दोबारा बता देता हूँ। पहली बात, जो भी पैकेजेज हैं उनको ठीक से बताना होगा डिटेल के अंदर। दूसरी बात, हाई रिस्क पैकेज का हमने वो कमेटी ने सजेशन दिया है। आज शिकायतें आती हैं कि 1 लाख रुपए का पैकेज था, बाद में पता लगता है 6 लाख रुपए खर्च हो गए। अगर आप अप टू 20% एक्स्ट्रा कर सकते हैं, वो जो उनका नॉर्मल पैकेज है 20% एक्स्ट्रा मांग सकते हैं कि भाई आपने हाई रिस्क पैकेज लेना है तो उसके बाद सारा रिस्क अस्पताल का है। आपको 1 लाख की जगह 1,20,000 देने होंगे, परंतु अगर बाद में 5 लाख भी खर्चा आता है तो सारा का सारा अस्पताल बियर करेगा। दैट इज कॉल्ड हाई रिस्क पैकेज।
हाँ जी, एक एक करके
चला रहे हैं, क्या इसके लिए भी कोई कमेटी को डायरेक्शन दिया जाएगा? किस तरह की प्राइवेट कैंटीन होना चाहिए जिसमें खाना बहुत महंगा मिलता है?
अभी खाने की तरफ ध्यान नहीं दिया, दोबारा देखेंगे। अभी हम दवाइयों की तरफ देख रहे थे।
सर अभी जैसे आपने कहा कि डेड बॉडी को बंधक नहीं बनाया जा सकता, तो ऐसे में तो मैक्सिमम लोग डेड हो जाने के बाद अस्पताल का बिल भरेंगे ही नहीं।
देखिएगा, ये लॉजिक नहीं है। अगर इस लॉजिक पे आप चलेंगे तो आपने किसी के पैसे देने हो, वो कहे आपके बच्चे को रख लिया मैंने, पैसे दे जाओ तो ले जाना, ऐसा नहीं होता। देश में कानून का राज है भाई। पैसे का लेन देन अलग चीज़ है और पैसे के एवज में किसी को बंधक बनाना वो पॉसिबल नहीं है।
Okay, some important points coming in there as far as the entire pricing mechanism is concerned. Ekta Batra is also there who tracks the sector very closely. Ekta, I know there are still some points that have to be cleared out, but from what you hear, what are the things that stand out in terms of, you know, the 30-day time frame that they've given, the pricing recommendations rather that they have made?
Well, you know, there was a 9-person recommendation team which had come up with certain things such as consumables by manufacturers should not be marked up beyond 50%. So that's exactly what's come out from the press conference, that this particular recommendation is taken forward, as well as other things such as all prices of all the medications which come under the National List of Essential Medicines have to be charged within that. Now, the reason why he has probably alluded to it is because there was an NPPA report which had come out in the month of February Feb, where they had mentioned that there was some amount of changes which had taken place in the drugs, which resulted in them not falling in the NLEM category, and hence there could be a different charge for that. So I think this is basically making sure that they do adhere to that NLEM list. Separately, they have mentioned that this is going to be open for public comments, and then after public comments, I think it will be then a final law. And in case you do not,
this is not clarified yet. This is basically the broad recommendation that they've put forth. Once there is a public comment consultation within that 30-day period, that's when they'll be able to formalize
if in case the hospitals don't adhere to this, then obviously obviously their license will be cancelled on account of that. And obviously smaller things, not smaller things actually, things which have happened in the past, which has resulted in them saying that, you know, you can take the body away despite the payment, you know, at that point in time. Nonetheless, we have Shailaja Chandra, the former Chief Secretary of the Delhi government, joining in. Shailaja, hi, thanks very much for taking the time out. So what are your first thoughts on these recommendations?
You know, the first time I'm hearing about it, could you tell me, is it a central notification?
No, this is by the Delhi government, and this I think would be limited to all of the NCR hospitals, and basically to ensure that all the consumables in the hospital are charged at 50% of the manufacturer's cost, as opposed to, you know, any sort of arbit amount earlier.
50% of the manufacturer's cost, or 50, not beyond?
Up to 50%. A markup up to 50%.
Markup, that's what you said, yes.
Yeah.
All right. So my reaction is, number one, that it will make the government very popular with the consumer, with the patients, with people who go to hospitals, because definitely there's a feeling that this markup is just profiteering and needs to be curbed. So on that score, I'm also a member of the public. I'm happy that such a step is being taken. I would, however, be a little worried that it should not be something which, after all, the enforcement is not being done by any particular entity, and if it's left to just the drug control mechanism, or it's left to the nursing homes division of the of the health sector of the Delhi government, it is too small and too deficient, and it will roll down to the level of inspectors. Therefore, to do this, you need a proper regulatory agency which has a look at, you might say, online data, which can take samples, which can listen to complaints, which can act on those complaints. Now, I don't know whether they have also announced that they're setting up a regulator.
They have, in fact, said that. They have said that the Delhi government will form a committee to look into and oversee these kind of issues of overpricing by private hospitals. But, you know, staying with this issue, while it is positive, the negative impact would be the fact that hospitals are already reeling under pressure. There is competition in the NCR region.
Yes.
There is...
I haven't completed what I was saying.
Go ahead.
You know, there is now a great need for expanded healthcare. We just don't have enough. And private investment can certainly be, a question mark. People can start thinking that, look, if there's going to be this kind of surveillance, why bother to even invest in hospitals? You know, it becomes something which can reduce the interest in the hospital sector. So I would say that it's a double-edged weapon. Definitely the public needs to be protected and looked after. On the other hand, one cannot make it is, after all, you have treated it like an industry. You've given it the status of industry. So one is not looking at what price you bought equipment for the power sector or equipment for the petroleum sector when you allow a company to do whatever it is. But having said that, I would say health is definitely an emotive issue, and people come from all walks of life. The rich can jolly well afford to pay all this and should be paying.
Yeah.
But
Shall
on the other hand, there are middle-class people, there are working-class people who also go to hospitals,
of course.
and therefore protection is necessary. I am extremely bothered about a committee approach. This has to be a legal approach. The regulator has to have teeth. They have to have proper legal teeth. I don't know whether there is such a sort of, you might say, and which law are they doing this under?
Yeah, that's a pertinent question. Let me bring in BS Ajai Kumar, Chairman and CEO of Healthcare Global, also into the conversation. Mr. Kumar, a very quick point on one of the points that have been highlighted in the advisory, that private hospitals can give high-risk packages and private hospitals will have to put a cap on packages provided to patients. The point of actually implementing this, do you think this would be workable in private hospitals if there is a governing body that is overseeing this?
Yeah, I think whenever we put certain types of regulatory body, workable cap, history has taught us one thing: it is a disaster. I think what we have to think of is, first of all, we should think of the fundamental questions. Are hospitals really making that kind of profits when you look at it in total? We should not look at what if they charge for the glove, what if they charge for a syringe. I think we should transcend way above that and look at what is the value-based medicine we do cost here for the same technology, everything we do, compared to other parts of the world, particularly even Africa or Philippines. I practiced in US for 28 years. I know what the cost is. So when you look at that, India has created marvelous healthcare system with value-based medicine.
Mr. Ajai Kumar, we're running short on time, so I just wanted...
This will destroy the value-based medicine.
Exactly. I just wanted to ask you that what kind of impact would you probably see on margins on account of this, considering that your markup would be lesser than what you were earlier doing?
Yeah, I think
Plus,
it will have already EY report says 6% is a return on capital. When it goes below that or even 6%, I think, as you said, a lot of hospitals will shut down. Definitely, a lot of hospitals will shut down in the NCR area. And it may be good because it will be a lesson so others don't repeat it. I think somebody is trying it, something in the interest of patient. We are all interested in the patient. We want to provide what is value-based medicine, not cheap medicine. But once they do here, like they're doing in Calcutta experiment, a lot of doctors are leaving and migrating away from Calcutta. Same thing will happen here. And that maybe that is a lesson. Maybe government hospitals should shape up and provide the right treatment. Why not? Why are they targeting private? Why not they shape up government hospitals so people can go there for services?
Okay, Shailaja, Mr. Kumar, very tight on time. We will have to wrap up this conversation. Mr. Kumar, one-line answer from you. 30-day time period. This is an advisory. What specifically are the points which could be a negative as far as the public comments are concerned? One quick line. What do you think would be the most important point that could be
I think it will affect the quality of care to the public. In a negative way.
Okay. We have been focusing on crude for the last few sessions now. Global oil prices have continued to slump this week as well. The Brent is now trading closer to that $75 a barrel mark. The drop in prices also on the account of increase in US crude production as well as OPEC and Russia's plans to increase output. However, this slide in global prices has not brought any relief to the Indian consumer just yet. Why so? Prashant Nair has done some number crunching and he's here with his analysis. Prashant, take us through the larger picture here. What's the reason for this?
The question which everybody is asking is, why are we paying the same or even more prices at the pump that we were paying last week or the week before that? Why are prices at the pump for petrol and diesel at all-time high levels, even as global crude oil prices have come off? Let me put the math first. I mean, this is roughly the math, right? A dollar drop in global crude oil prices should result in approximately 43 paise reduction in petrol and diesel prices. Everything else remaining the same. From everything else, I mean mainly the exchange rate. And this is before state VAT. State VAT, of course, varies from state to state. Some states have got it very high. Some states are more reasonable. Let's see what has happened to the next graphic. I mean, essentially, you got global crude oil prices, Brent prices, which are down about $4 over the last couple of sessions. So global crude oil prices down. What has happened to the rupee dollar? The rupee is actually appreciated, which is actually good news if you're an importer. Your currency is stronger. What has happened to what we pay at the pump? Well, that actually has gone up. So over the last 2 weeks, petrol and diesel prices are up about 5%, over the last 2 weeks or so. So there is a dichotomy here, and that essentially is what we are trying to address. Now, remember, even as, petrol and diesel prices remain at all-time highs, what we pay at the pump, one thing has to be made very clear. If you take the current exchange rate and the current crude oil prices as it is, what oil marketing companies make as gross margins are still very, very negligible. They are nowhere near where they were pre-Karnataka elections, for example. So that having said, let's move on to why we haven't seen the benefit of lower global prices coming onto the pump. And the reason is essentially the way this is calculated. So what we do is we take the 15 rolling average for global crude oil prices, and that gets reflected to what you and I pay every day, what oil marketing companies like HP, IOC, BP fix every day. So I think this chart will make it very clear. The close on Friday, that is the last day, was $75.90 for Brent oil prices. But you look at the 15-day rolling price, that was $77.86 odd cents. You go back a day and you see the difference. Actually, you go to the May 23rd, the third row on the graph, on the table, and you see that the Brent price was 79. So from 79 on the 23rd of May, on the 25th, that is on Friday, we've come down almost $3.5 odd. But look at the change in the 15-day rolling the second column on your table, which is the 15-day rolling average price. From 77.85 on the 23rd of May, it has only dropped a few. I mean, it's actually unchanged, $77.86. It's actually 1 cent higher. So even as over a 3-day period, and we're looking at some other days as well, the past couple of days, but the point I'm making is the impact, the formula which is used to calculate this is a 15-day rolling, so there is a 15-day lag from when prices start to correct and when it shows up in the daily, price setting which IOC, HP and BP does. So I think all we have to do is to wait for oil prices, that is global oil prices, to stay where they are, to actually even hope that they drift a little lower, and eventually you will start to see that seep in to what you and I pay at the pump.
Okay, Prashant, thanks for that. We will have to cut into the press conference for Lawson & Trubro, who is addressing the media in Mumbai.
Even though they have not been cancelled by the customers. The orders came largely from infrastructure sector, and this has been the pattern for the company for many years now. 57% of the orders that we procured during the year came from infrastructure vertical. We had hydrocarbon contributing 10% of the orders that we have won during the year. And the services business, and since it is a consolidated results that we are announcing, the services business revenues are treated as orders, and they account for 17% of the total order inflow for the year. The order book, we spoke about the order book at 2.6 trillion. If I look at the E&C revenues that the company is likely to have at the current rate, the order book reflects 3 times the E&C book to bill. What this indicates is a certain predictability to the revenue profile of the company for the next 3 years. And there are enough orders in the tank for us to work on to be able to sustain the revenue and profit growth plans of the next 3 years. This is not to say that we do not need any further new orders in the 3-year period that we are talking about, but all that we are saying is the baseline is adequately covered, and what we need is the top-up churn that the environment will provide us the opportunity, and L&T will have the competency and the competitive advantage to take advantage of that situation. We do think that close to 2 trillion rupees is from infrastructure orders, so the revenue profile of the company will reflect the huge backlog of infrastructure orders that we have. And with hydrocarbon joining the party, so to speak, we have almost 266 billion rupees from hydrocarbon, which will also play out over the next couple of years. Just a point, while the infrastructure orders are long gestation orders, generally, hydrocarbon is relatively short gestation. To that extent, their conversion into revenue could be faster. The performance of the company, both for the quarter and for the full year, in terms of revenue, the performance have been moderated, the revenue lines have been moderated for the GST, and the excise duty adjustments that I spoke about. So for the quarter, the revenues are at 407 billion rupees, which is 11% growth. And for the full year, it is at 1.1 trillion rupees, which is 9.5% growth. The international revenues, the share of revenues from international contracts is 29% for the Q4 and 33% for year as a whole. We do believe, given the backlog of international orders that we have, around 30 to 32% would continue to be the share of international revenues in the order book going forward. The manufacturing and construction expenses reflect the improvement that we have made in terms of operational efficiency programs that we are running across the company. So even though the absolute numbers have shown an increase from 727 billion rupees to 773 billion rupees, a 6% growth, the fact that the rate of growth is lower than the rate of growth of revenues indicate that these have been a major contributory to the growing EBITDA of the company. The finance charges are actually the finance cost of the financial services business, which are treated on par with the manufacturing and construction cost, because for finance business, money is the raw material. They have grown by 12% from 54 billion rupees to 60 billion rupees for the full year FY18. The staff costs have recorded a 10% increase from 139 billion rupees to 153 billion rupees for the year as a whole, and these are largely on account of staff augmentation that we have done for the services business and the staff rationalization that we have done in some of the core projects and engineering businesses. The sales and administration cost records a 10% increase for the year as a whole from 70 billion rupees to 77 billion rupees, and these reflect the provisioning that we have made both in financial services business and all the other businesses in terms of non-recoverability of customers' dues in terms of anticipation. The total operating expenditure has moved up by 7% from 989 billion rupees for the year ended March 17 to 1 trillion rupees for the March 18 period, recording a growth of 7%. Consequently, the EBITDA of the company has been 54 billion rupees for the quarter ended March 18 and for the year ended March 18 at 136 billion rupees, which is a 22% increase. The EBITDA margin are gone up by 120 basis points from 10% to 11.2%. The finance cost has shown an increase of 15% for the period ended March 18, the year ended March 18. And these reflect largely the larger funds that were in use during the period of the 12 months and a 40 basis points increase that has been witnessed in the financing cost. The depreciation and amortization shows a reduction. That is largely because of the amortization that we did to some of our assets in the previous year, which no more exists in the current year. Consequently, the depreciation and amortization line are more normative than they were reflected in the past year. Other income has grown by 5%, largely representing our treasury income. We had exceptional items in terms of sale of some of our small businesses, which has $1 billion in terms of contribution to profits, and they were quite similar in the previous year as well, because as a part of our portfolio restructuring, we are constantly looking to exit some of the subscale businesses, which though profitable, does not provide us the ammunition to scale the revenue and the growth targets that we have for future. The profit after tax, hence, at 74 billion rupees records a 22% growth over the 60 billion that we recorded in the past year. Connecting the financial results with the segment performance, you are very familiar with the segments that we have been reporting, and there are no changes to the segment reports that we have produced so far. And hence, looking at the individual segments, we have infrastructure segment as the lead segment, which has a quarterly revenue of 229 billion rupees, which is 14.6% growth over the 200 billion rupees of the previous year, quarter 4. And for the year as a whole at 590 billion, it is up by 11.8%. The overall revenue growth of the company is largely aided by the growth of this segment, both in the quarter 4 as well as for the full year. The share of international revenues for this segment has been for the year as a whole 173 billion rupees out of the 590 billion rupees that we have reported income. The EBITDA margins have marginally declined from 10.2 to 10 for the infrastructure segment for the year as a whole, and these are largely reflective of the mix of jobs and the stage of completion that they are in, and do not indicate anything in terms of structural direction. When it comes to power, the segment, as you know, is facing a lot of headwinds in terms of opportunities for thermal power. And we, as you know, we do the EPC business for thermal power. And the intense competition for the limited opportunities that are existing both by the domestic players and the international players. Consequently, we have not been able to win orders of the magnitude that we would prefer to keep this segment in pink of health. There has been some compensation by the segment winning some orders overseas. We won an order in Bangladesh, and this is continuation of a couple of orders that we have won in the prior year. So the segment revenue overall shows a decline of 10.6% for the year as a whole, from 69 billion rupees to 62 billion rupees, reflecting the declining order book. It's very important that this segment begins to win some orders for the growth trajectory to return back to the revenue lines. Otherwise, it will tend to reflect the decline that is evidenced by the order book. The EBITDA margins stays low at 3.4%, marginally lower than the 3.5% of the previous year. And it is important to know that at EBITDA level, the performance of the subsidiary companies that we have in the power segment, namely the JV for manufacturing boiler and the JV for manufacturing turbine, those profits are not included in the EBITDA level at the segment. They're included at the PAT level of the segment, and it will be interesting for you to note that about 150-160 crores of profit are made by those JVs for the year as a whole, which will go to improve the overall returns of this segment. Moving on to hydrocarbon segment, the turnaround has been complete. A couple of years ago, this segment was under a lot of stress in terms of orders where costs and time overruns were hurting the financial outcome. For the quarter ended March 18, the revenues recorded were 35 billion rupees, which is a 37.9% growth over the quarter 4 of the previous year. And for the year as a whole at 1.17 trillion rupees, it reflects a 22% growth. The share of international revenue is significant for this segment, largely because of the order backlog, which reflected the international orders that the segment won in the prior years. The EBITDA margins consequently has improved from 6.8 to 7.7%, reflecting the increased scale of operations as well as timely execution. The projects that we are currently executing are all on time and on schedule,